because this is inflationary period and all those stuff. But there are two more methods that has unique characteristics and that can change your profitability, your balance sheet, and your taxes. And that is FIFO and LIFO. So first in, first out. What does it mean? It means first inventory that you purchased or that you have a balance, that will be sold first. So remember, these are costing method, not inventory management method, that which inventory to be sold. Of course, in go down, when orders come, you just pick the inventory and just deliver, that's it. But this is costing method, how you are write down the number, that's it. All right. So FIFO means first in, first out. So first that you purchased, all right, that will be sold first. So first cost into inventory as first cost assigned to the cost of goods sold, which means oldest items assume to be sold first. Balance and then purchase one, purchase two will be sold first. All right. So let's just talk about this. We will talk about this when we do analysis, that ending inventory is based on latest cost. Let's just talk about that. So we have the same scenario. Here we go. So 40 units have been sold, 20 is on hand. So according to FIFO, please apply FIFO. First in, first out. So what was the first in? These units were first in, and then you first bought this one, and then secondly this one. 40 units has been sold. So which units will be sold first? The balance. And then which units will be sold after that? We have 30 left. And which costing going to be sold first? And then these 25. Right? And then still we have 5 left. Still we have, and 5 left going to be sold from here. So do you have the costing now? So 10 units that we sold first in, first out. First in is first 10. So these are the costs. All right. 30, 25 units. There. 25 units, their cost is 40. And a 5 units were from here, so their cost was 18. So this is the cost. So which means 100 plus 50 because these fully sold, and 18 multiplied by 5. So let's see, very nice. Right? 18 multiplied by 5 is 90. So what is the cost of goods sold? You add all these. So these are called the cost of goods sold. 540. If you add them, 540. So 540 is your cost of goods sold. Now you tell me, inventory left 20 balance, 20 units are left. So that 20 units are these, from these. All right. So these multiply by 8. 20 multiplied by 8 is 360. So did you notice something? That from here, the ending inventory or in-hand inventory, the cost is latest one. All right. So when cost is latest one, then this figure is greater. Right? 10, 14, and 18. Cost is based on biggest number. So ending inventory or inventory on hand gonna be bigger number, right? So this will go to balance sheet. When balance sheet will take a bigger number, the balance sheet asset side will be greater 1. All right. Balance sheet will be greater 1. So by changing or by manipulating from different methods to FIFO, FIFO will give you bigger asset base because it contains ending balance of inventory with latest prices. And remember, this is inflationary period where things are getting more expensive and expensive. There is a rise in prices, which is a normal scenario nowadays. So that argument that we just read here, ending inventory is based on latest cost incurred. We proved it here. Guys, you understand? Oliver, Nana, Babaroon,
Yeah, understood.
Yes.
Marco, Faik, PD, Job Hollow, Subhan, 10, Miria, Venetia, Noon,
Yes, sir.
Priscilla.
Yes, sir.
Any question regarding?
Yes,
FIFO?
sir. No questions, sir.
No.
Okay, good. And now the opposite one is last in, first out, which means lastly we purchased will be sold first. Which means last cost into inventory go to cost of goods sold and oldest inventory cost in the ending inventory. So let's just talk about that. Last in, first out. So which one is the last that we purchased? Last we purchased these 25 units at 18. So we sold 40 units. All right. First, these 25 units will be sold because these are lastly purchased. All right. And then how much left? 40 minus 25, 15. So 15 gonna be this one. 15 multiplied by 14. That would be your cost of goods sold values. All right, will be sold first. Now, what is the ending inventory? 20 units left. Right? So 20 units left, 15 already sold from here, 10 left. So 10 with 14 units and 10 with 10 price units. So total is 240. All right. So your cost is 660. So did you notice something? That your sold items, 40 items, assume latest cost. Your sold item assume latest cost, while your in-hand inventory assume oldest cost. That's what is written here. Last cost, which means latest cost into inventory of cost of goods sold, where have the oldest cost in ending inventory. So what are the implications of these two methods? So if you compare, let's okay, we do have an example here. We will do that, but first let's understand its implications. So in LIFO, inventory cost is based on oldest item, lower item. So your asset base, asset side will be lower, right? Since your costs based on highest items, highest prices, so your cost of goods sold is highest. When cost of goods sold is highest, your net profit is going to be sale minus cost. Highest cost means your profit is going to be low. Low multiplied by tax rate, Absolute value is also low, tax rate also low. All right. So it means the choice between LIFO and FIFO disturb your financial statements and tax implications. All right. So first, let me see that whether you understand the average costing, LIFO and FIFO. Please take a picture, and we will be having a breakout room activity. So those who are watching online, please pause the video, try to solve it by yourself. I'm going to be pausing the video here and standing up the breakout room activity. All right. So see you after breakout room. Okay, class, welcome back after the breakout room activity. So I have received your files. So those who are watching online, so let's do it together. So we have Hazelwood surplus begin March with 75 CNN, 75 tents that cost $16 each. So their beginning inventory is 75 tents. And during the March, they ordered the following purchases. We have chronological order. Purchases are 3rd of March, they purchased 95 tents at $18. 17 tents, 17 March, 165 tents with 20 each. On 23 March, 35 at 21. So the company sold 318 tents. So number of tents sold 318 and 52 they have on in-hand inventory. Whether and the sale price is 45. So determine the cost of goods sold and the ending inventory based on average costing, FIFO, LIFO. So let's just see that. So you make a chart here, right? So your total inventory available was 370, which is the addition of all beginning and purchases. And your cost of goods sold inventory, which is your sold items, 318, and 52 is your total inventory, right? So let's just talk about that. How much is the cost of goods sold and how much is the ending inventory? So first, we have average costing. Let me change this. I think we made a mistake here. There should be average cost. Here, average cost. Inventory at average cost. How we are going to calculate it? So simple. You add all the costs, that is 6945 divided by 375 units, 370 units. So you would find out 18.77. So how much is the how many items are sold? 318. So 318 multiplied by 18.77. Right? So 5969. And how much is the inventory? 52 items multiplied by 18.77 per unit. So your 9